This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless Day Trading Frank. It's approximately 8:29 p.m. Eastern Standard Time. It's May 30th, 2019. Last day, I believe, second to last day of the month. Trading month and calendar month ends tomorrow on May 31st, Friday. Full disclosure, this is purely for financial education, not for any solicitation or advice. Session will be recorded, uploaded to the Google YouTube channel for Clueless Day Trading, as you all know by now, and anyone else who's going to be listening to this later, and other people who are accessing our Google YouTube free resources can review these strategic webinars, which are extremely helpful, and try to forecast and draw a roadmap for markets going forward. And feel free to pass the word around. We also have a terrific Instagram channel where we highlight some of our more powerful trades, and feel free to pass the word around, and certainly follow us on Clueless Day Trading Instagram. It's primarily for promotional purposes and not for any real-time data and content that is solely delivered on the Clueless Day Trading Twitter feed, private Twitter feed, only accessible to paid members. On that note, let us begin. I don't need to remind anyone that we are living in extremely volatile and critical phase in the market. We have gone through many of these phases before, not the first time. And of course, as we all know by now, that life is the ultimate teacher. So having gone through many crisis situations in the market, I believe that Clueless Day Trading and myself are well adept at navigating to a large degree the unexpected nuances in the market, regardless of what happens. There's an old saying that I used to mention to all my clients back on Wall Street, institutional high net worth clients, that every crisis is the same for different reasons, and that applies to life also. Saying all that, we have had a blockbuster breaking news, and these are the black swan events that no chart, no technical forecast can predict. However, we do have a roadmap in place where I have been very in excruciating detail showing every single day through a lot of diligent hard work, as you all know, where the bottom end of the market is, where the trading ranges are, where we can fall to. In other words, the probabilities of both the lower end and the probabilities of the reflex bounces with on the upper end, and where they might get hit a brick wall. So saying all that, we're going to go through this today so everyone is well prepared. We have had a blockbuster news announcement just within the past 30 minutes that President Donald Trump is going to impose a 5% tariff on goods coming over from Mexico over this illegal immigration crisis. Now, I don't want to get into the politics of it, but this is obviously an extreme negative short term for the U.S. financial markets and the overall U.S. economy for a simple reason. Mexico and Canada are our largest trading partners. We have huge amounts of factories, U.S. companies, which have assembly plants and all kinds of operations on both sides of the border, both on the north, on the Canadian side, as we all know, and on the south, on the Mexican side. Now, also keep in mind that President Trump has successfully negotiated a terrific trade deal between between Canada and Mexico, what was known as NAFTA before, North American Free Trade Agreement. Now it's called the United States Mexico Canada Trade Agreement. I believe that's what it's called. I don't have the abbreviation on top of my head. And he has successfully negotiated that, and he's pushing Congress to ratify it, which in itself is a very powerful deal. So the fact that he has gone ahead and put this blockbuster, at least, could be bluster. It's, again, we all know President Trump is great at putting these things through and then negotiating it through. However, on face value, this is a total negative. Futures accordingly have dropped about 23 points. I'm going to go through that too, so we can see that. You can see that live futures here. This one is a live ES weekly futures that I've been talking about. And on a technical basis, market will be severely, extremely oversold if futures remain down 22, which I think they will, going into tomorrow, at the opening tomorrow morning. So saying all that, this Mexico being one of one of the top two largest trading partners and manufacturing hubs too, assembly hubs for many, many, many U.S. companies. Obviously, they are big buyers of U.S. goods. We don't really buy a lot of Mexican stuff per se. We buy assembled stuff that's assembled in Mexico. And obviously, this is a big negative, whichever way you slice it or dice it. Now, what the subsequent steps are going to be by the Trump administration, we do not know. But this is an opening salvo on a battle, which at this point, in my opinion, the markets and the overall U.S. economy is not necessarily going to like. So we shall see what happens. We are not governmental people. We're just ordinary citizens, good patriots here in this great nation of the United States of America. So we have to obviously go through with whatever machinations the government is doing on many different fronts. So on the principal front, the illegal immigration issue is a major issue. We all acknowledge that. And of course, over the last couple of months, President Trump himself has said that Mexico has been very cooperative in trying to stem the flow of illegal migrants coming in from South America. They use Mexico as a corridor, obviously. So why this sudden harsh announcement at tonight at 7:30, 7:50 p.m. You got to scratch your head. It's all a hardcore bargaining tactic. But what exactly they're bargaining, given that he is pushing through the trade agreement between, the trade agreement, I'll call it NAFTA for now, North American Free Trade Agreement, which he himself and Mexico signed very successfully, and Canada signed. As you know, he moved tariffs on Canadian steel and all that stuff recently. So why, after all that, this is coming through instead of private discussions and stuff, we don't know yet. So we leave it up to that, one step at a time. So that's what's going on right now. Saying all that, I'd like to remind everybody that throughout this overall market, throughout this massive volatility movements every single day, we are actively trading as active traders on the day trading side and sometimes on overnight swing trades. We are at this point being overall net positive. These are extremely difficult times. There are two options you can do. One, you can do nothing and wait for some sort of bottom, which comes and you have these big 300-point rallies and then they give back. So I don't think just sitting SOA, sitting on and not doing anything, despite there are multiple very powerful sectors and winners in those sectors like United Health, like Anthem Health, like Humana, and many other companies which have gone the other way through this extreme turmoil. I don't know sitting on the sidelines is worthwhile, but that's up to you. That's the decision of every single trader or member. In my case, I am an active trader. This is my business. This is my living. I don't get a paycheck from anywhere else. I don't look for handouts from the government, and so I have to trade. And so obviously, that's a different story. Now, a couple of things which I want to put across to all of you as we speak here. These times that we're going through, this is not the first time. We have gone through massive volatility environments back in 2018, back in early 2019, and now we're going through this right now. There has never been a smooth ride in the market. The only time it's been smooth is when you have bought tactical trades on big tactical retracements or pullbacks, and enjoyed the fruits of your labor and your patience and your discipline, and made some extremely powerful profits as the markets have these reflex bounces. We are overall technically still in a bull market, but I will show you tonight that we are on the cusp of breaking the bull. This is the first time you're going to hear from me, okay? We're on the cusp of breaking the bull market at this point for reasons which have to do with the U.S.-China trade war, now the salvo against Mexican, if we're opening up another front on the Mexican trade war. We have had issues with the Europeans, which have been successfully pushed out towards, I believe, September or July, auto import stuff. So the markets are feeling the strains of this constant push and pull of these big macro events that are taking place. So we'll go through that. There's nothing bad or good about it. As tactical traders, every single day, I'm showing a lot of winning trades. We have to, as the market is pushing us because of the extreme volatility, to become more short-term traders, both on the long side and the short side. So short-term profits intraday, couple of hours, bang, you can make 30, 40, 50, 60, 70%. We do intraday puts, which generate anywhere from 60 to 100%. If you kept it overnight, you'd be up to 200 and 200%. And we show that consistently. So saying all that, this market is at this point only, let's put it this way, RSVP for tactical traders. The emotional trader who thinks that the markets go up in a straight line, which is a complete myth, so those type of price chasing emotional traders who are not trading charts, I hate to say, are just not going to survive. They will blame everything in sight for their misfortunes, but there is no one to blame. Like they say, take self-responsibility. Try to learn how to trade charts. It is not easy, especially in extreme volatility, but over short time frames during the day, sometimes overnight, you can still make some pretty decent money. So that's only, that is probably the most wise suggestion that I can offer to my members and my great traders at Clueless A Trading and anyone else who's going to be listening to this. All right. So that's it. Let's not, harp over everything here. Now, the other thing to keep in mind, and I've shown this a few times, and as I'm talking, I'm going to go ahead and just flip through the charts so you can see where we are. Futures right now are down 22 points. This is that drop on the Mexican announcement, tariff announcement. Is that because of all this constant push and pull and the strain, the bond market, the U.S. Treasury bond market, and primarily the 10-year bond and the 2-year bond has had a inversion, as a yield inversion. It's an inverted curve. Please read up on it on Google. Read up on it when I tweet out the articles. It's a little bit technical, but basically, the yields on the 10-year and the 2-year have the spread has widened quite a bit, and the yields in some cases have, not in the United States, but in Germany, have gone into negative territory. In other words, it's crazy. I mean, you got to pay the bank to keep your money, instead of bank paying you. So these are all the yield inversion, or the inverted yield curve basically implies that we have a recession looming. It's not a certain guarantee. It's not a perfect signal, but it disconnotates some pretty ominous situation here. Okay, just keep that in mind. I'm positive knowing President Trump from the days, I'm a New Yorker, so obviously we know a lot about President Trump. I do not think he wants a global, and more specifically a U.S. recession right before the elections in 2020. That's pretty obvious, okay? Regardless of all the political loyalty and everything, U.S. economy goes into a recession, the buck stops at the president's desk, right? He's the president, so he has to take responsibility. So I don't think he wants that, but the market is sending some pretty ominous signals that if certain things are not, deals are not cut and negotiated, then the U.S. economy will push itself into a slowdown and cause a recession. So that's another thing to really, think about. Saying all that, the doom and gloom in the market is extreme. The investor sentiment, the trader sentiment is has flown out off the charts on the bearish side. Mom and pop, which basically means the average investor out there, is certainly not putting a single dime in the stock market. In fact, pulling out money from their growth funds and their stock funds, primarily the mutual funds they're in, and putting them into the money market. And some extreme readings are being shown both on the technical chart as well as on the investors' intelligence charts. I've been saying this for a long time. Mom and pop has been out of the market for a while. Okay, they came into the market in droves back in 2018 in January, and then the market collapsed really hard. And I think after that, they were just like, see you later. So there is a there is a huge amount of cash on the sidelines. However, that cash seems to be reluctant to enter the U.S. financial markets, even when we have the sporadic periods of big reflex bounces. So therein lies the power and the opportunity presented, and that only can be captured by tactical, chart-orientated traders. That's what I do. That's what I try to help everybody do. That's what I try to teach everybody do, and that's the only way to do it. So there's be a lot of opportunities, ladies and gentlemen, both on the short side and the long side. And at this point, with readings that extreme, these type of sharp reflex rallies that appear from nowhere, we have seen it happen many times. Market's down 600, ends the day down only maybe 100, 200 points. You will see it happen quite a bit. However, word of caution, as I said in the past couple of minutes, the market is getting technically fatigued. And so from a technical standpoint, we might enter a short period of a mini bear market. Many stocks are in bear market. They're down more than 20%. Look at some of the big stocks like Apple and stuff. They're down 15%, beyond 10%, sometimes 20% in many cases, so many other stocks. So it's getting there. All right, let's see. Now, this is where we are as I'm speaking to you. And I want to remind everybody that every single day, those real-time charts with the comments that I put out there are probably one of the biggest resources anywhere that you will find to understand what is happening in the markets, how to make some money off the markets. So honestly speaking, these webinars are not even needed because my real-time Twitter feed is an ongoing real-time technical story and fundamental, because I put the comments down and stuff, story, which narrative, I should say, which speak for themselves. So saying all that, let's take a look here. So this is your short-term chart on the indices, which we trade pretty successfully. These are these big flash crashes. Here's another flash crash in the past hour, right? Since the Mexican announcement about the tariff announcement from President Trump, right there. This is where we were at 11:45 on the 29th, which was yesterday. This is where we came up to, exactly where I said, which was this line here with the red arrow, right there. This is the range we were traveling in, which we broke. And we broke that pretty viciously on that flash crash at 2:45 p.m., starting at around, starting on the start of 9:30 a.m. on the 28th. That was 2 days ago on Wednesday, right there. Comes down, gets into the gap, tries to hold it, falls, tries to re-enter, falls, and then this big sharp move. These type of moves we catch very successfully. We also played the intraday puts on these very successfully. And now this is where we are. As you can see, there is a methodical madness to the market. It's a very methodical market. It's a market driven by algorithmic high-frequency trading black boxes. And that's the only reason why my charts are so precise. That's the only reason. Otherwise, how in the world would I draw these lines and structures? And that's exactly what the markets would hit on the upside or the downside. And then you'd be able to trade those levels. That's only because the machines look at structures, they look at patterns, they look at numbers. No emotions. The algos have no emotions. There's an old saying, algos have no memory from one day to another. They have memory on structural patterns. So saying all that, you can see here, there we go. This is where we are right now, attempting a mini bounce. Futures were down about 25. Now they're down 21, means nothing. Just look at the structure. So at this point, is this possible? It sure is on the short term. Now we have a downtrend line here that intersected right at the re-entry of this big resistance, the gap that we fell through. Talked about it this morning, told you guys to sell the levels there on this move up. And from yesterday, you can see, trade off these charts. It's really as simple as that. I don't want to keep on reiterating the same thing. And at this point, this downtrend line will act as resistance, and that would be around 27.90. That's quite a bit if it goes there. So unless I am not going to make any projections at this point whether or not it's going to go there because of this salvo of this Mexican 5% tariff threat that came out from President Trump. But at least you know where, if you buy into tomorrow morning and there is a quick short covering rally, this is where it's going to get hit. All right, so that's your short-term charts, very structural. You can see that. Whether or not we can get up here, I have absolutely no idea at this point. I don't. This China trade war is heating up, and as I said, it's taking a nasty turn. The Chinese need to I shouldn't say buckle, but they need to soften up their stance, and we need to ease back a little bit on threatening them right, left, and center, and basically we need to lower the heat in the war of words. We don't have a choice. We got to negotiate with them, and they need us. And believe me, we need them. So that's just the way it is. They need us a heck of a lot more than we need them. But to detach completely, which is not physically possible, keep all your political ideas and all that on the side. It is not economically possible in a global economy that is interconnected. We are, after all, a trading nation. 80% plus of our profits of our great U.S. businesses come from overseas sales. So it is not possible to just detach. And we wouldn't want to do that. We would not be a global superpower if we just detached economically or militarily from the world. That's not the way it goes. That's the reason why we're number one. So bottom line is that the war of words, as I use that word today, needs to ratchet down a little bit. And I'm sure there's internal deliberations and conversations going on between the U.S. trade team, the U.S. administration and the Chinese, aside from the public rhetoric. We know that. So saying all that, it's pretty explanatory what's going on. And at this point, the most bullish event would be, and I don't know what could cause that, to be honest with you, but anything can happen. Overnight, we can get a tweet that the Chinese have finally started to come around with some of the hard demand that we have demanded, because that's the nature of game theory and poker, and you could get one of these real fast. But it cannot be projected just by looking at the charts. I said that would happen if this is what the charts would do if it happened. Okay, next one. These are your short-term charts. You can trade them reasonably successfully during the day, and you can see how precise each of the levels are. I've always had, and I've been doing so more so, marking them with arrows, sell, buy, that type of stuff. This is a 15-minute chart, so lots of choppiness. Each candle is 15 minutes. and these machines can drive you nuts. They certainly drive me nuts, with all the chop that happens during the day. Okay, next one is just, this is, let's make a chart. This is simply the one from today, the same one I just showed you. The next one is your 1 hour chart. So it cuts out the 15-minute volatility, and this is the zone that we were trading in, right there. We broke that, we came up, we tried to enter it, resistance kicked in, sell off, and this is the futures down 23 right now on the Mexican tariff threat, I should say. It's not official, from President Trump tonight, right there. Now, looking at these charts, we can project out where the lower levels would be. So we're going to look at the daily chart to figure that out. So use the daily chart, right? We are at extreme oversold levels. You can't go below minus 0.41 or stuff on the stochastic. You can see that. Okay, just the way it is. I zoomed in. Otherwise, it'll be looking like this, going all the way to Christmas Eve. Right there. Oops. Right there. Okay, so that is what the chart would look like. But what we're focusing on is the near term and what those levels are. So this one is very clear. Now, nobody in the world was expecting this announcement to come up at 7:30 in the evening. So far we were holding fine. We were not holding fine, but at least we're holding. And the markets, 1 second. The markets pulled up. Lots of different indicators were showing that we are okay to continue with the reflex rally, but that obviously, at this point, markets ended up at the high of the day. As we know, they were vacillating around in a tight range, and they ended up around 44 points. But obviously, that technical formation has been damaged because of this news announcement that came out at 7:30 in the evening. So saying all that, this level here, where the markets had a substantial bounce that was back on the 8th of March, is the first reference point. This is the level that all of you know is the 2018 break-even level. That's at 26.72. So forget that for now. Let's look at this level here. This level is 27.19. Let's round it up, 2,700. 2,700 is basically another roughly 600 points from here where we close the market today, okay? Roughly 550 to 600 points, the 2,700 level. So this is the level we'd be looking at to have a sharp bounce. Technically, markets, despite deep extreme oversold conditions, are showing the fatigue and stress of all this stuff that's going on. The 34-day moving average has crossed below sharply over the 50-day moving average, which was still climbing till about the 21st, just a couple of days ago of May, right there. It is buckling under the pressure. The constant strain of big liquidity sellers, the constant strain of trade wars, economic recession indicators and fears. Companies openly, US businesses openly talking about how their supply chains are seriously being disrupted and will affect the prices on a lot of basic goods. That are being tariffed. So if earnings warnings start coming in from large companies based on this trade war, rest assured we're going to be a lot lower. And the second half rebound on the US stock market, which was talked about a lot, will disappear. It's just the way markets are. And that will throw us into a mini recession. And I don't think anybody wants that. Neither does President Trump want that. Whether it's a rate cut from the Federal Reserve or not, it doesn't matter. The Federal Reserve can cut rate to zero right now. What's that going to do with trade wars? Think about it for a minute. All right, I'm giving an extreme case. The Federal Reserve can go out there and go nuts tomorrow cutting rates. What's that going to do? Make you feel better? Because the other risks, the macro global risks, these trade risks in the markets are not going to disappear because they cut rates. Remember, cutting rates is like shooting a bee, putting you on some serious medication. So what does that tell you? That you are healthy? That's why the doctor's putting you on some serious medication? No, you're unhealthy, you're sick, you have some medical issue. That's the doctor's putting you on some serious medication. That's heavy-duty cutting rates. You don't give heavy-duty medication to a healthy person. Think about that for a minute, okay? So cutting rates is not a panacea or a remedy. It should only be done during times of extreme duress. And you hear the Fed governors talking about that too. In times of extreme duress, the Fed cut rates tremendously and was criticized thoroughly for it over the past couple of years. And it helped the US economy recover and flourish. But at this point, unless if we do fall into a severe slowdown, the Fed will be forced to cut rates. But unless the major issues are addressed and remedied, the markets will have these reflex rallies and then see you later, and they'll keep on trending down. So technically, that's what the market is trying to tell us here. This line is your mid-Bollinger. This is your 50. This is your 34-day moving average. See how they're sloping down? Not good. Not good. This is just, from a larger perspective. It's not good. So at this point, I would probably make a technical bet that we are going to hit the low 2700s, if not 2700. So let's get prepared for that. Buy some puts tomorrow. Now, if President Trump comes out and said, "Okay, Mexico agreed with my assessment on this thing, and I'm not going to put tariffs," then see you later. The whole technical and psychological picture changes. But we go into a dual front trade war. See you later. Okay? That's the way it goes. And Mexico, in many cases, is far more important to us for our immediate needs than China. Okay? So there you go. So looking at that, keep the 2700 at bay as your target. Technically, that's what it looks like. And let me see the color on this. Let me change this color. There. Now, everyone keep in mind, everyone knows that I'm a patriot. I'm a bull on America. I believe in American exceptionalism. I believe in practical remedies to difficult situations. I don't believe in dogmatism. And I believe in, and I am certainly have been, always been overall bullish on the US economy and stock markets. So far been proven right. So what I'm talking about is short-term technical bearishness does not in any way or form change my thought process or my feelings whether or not we can recover from these situations that we're going through. We always find solutions, always. But the process is what we are talking about. So as traders, we have to adapt to short-term bearishness, and that's what it looks like right now on the charts. So this is the level I believe the markets are going to fall. If things remain the same, then we are going to fall into this 2720 level by tomorrow. By tomorrow. So even if the market opens up, rallies, maybe 30, 40 points off the lows, technically speaking, you want to short that. So this is your daily chart. We should be very clear about this. This is what we're looking at right now. After 2700, what happens? We're going to look at the next chart. Bang. Extreme readings will show up on the McClellan oscillator, on the stochastics, on the MACD, and many other indicators that I follow. But that doesn't necessarily mean that it's going to immediately create a reflex bounce because of the serious nature of what is going on. Okay. Another thing to keep in mind, just so I'm sure all of you know, mom and pop doesn't really, they haven't invested in individual stocks in God knows how long. I'm talking on average. So if they want to, they're very good about the market, they play through mutual funds and they play through ETFs, exchange traded funds. So what happens is when every day the market is attempting to rally and they're getting hit overall, they constantly keep on basically saying that's it. They're selling their ETFs. Now ETFs have to do some heavy duty selling, generally speaking, during the day, especially at the latter part of the day, to keep cash on the sidelines so they can, so just in case they gotta, to basically, if they get sell orders, they gotta sell. So that ETF volatility, exchange trading for ETF volatility, is what also causes massive moves on the downside on the market. So on up days, on risk on days, as we know, there's money coming into the ETFs. So those surge forward, but they're a big, one of the largest components of the volatility in the market. But just, hedge funds play ETFs. So they're buying and selling that like crazy every day. But in general, the ETF downside volatility has been one of the major causes. ETF selling has been one of the major causes of the downside volatility. So we're clear about this chart. The next one will give us a better idea. And this one I have reasons to get excited about because what I'm seeing here is a massive, back on the Christmas Eve massacre, this downturn, which was historical, huge up days, huge down days, and then the final collapse, and then the massive move up, a generational buying opportunity that we told our members and traders to buy. The stochastics got down to this level. So that is what we're coming down to right now. It's really that simple. Now, the minute it goes down there doesn't mean it's just going to go like this, unless we cut some deals. It's all about deal making, right? Otherwise, it's going to come down, attempt to go higher, slip and slide again. But at one point, it's going to turn. But that length can last a couple of months. Just letting you all know. That bottoming process can be 2 months, can be 3 months. This was 3 months, October, November, December. In between, we're going to trade every day. We're going to find winning stock. We're going to do some intraday shorts. We're going to pick up the Zillows of the world that have gone from $34 to almost $45 just in a month, and many other tactical plays. But I'm talking the general market. So this process could last 2-3 months. It's not going to be a one-day turnaround, ladies and gentlemen. The market technically on the weekly charts is broken. I talked about the last webinar that this was starting to flatten. If you all remember, listen to my last webinar. I said if it's going to start to keep on going down, we're going down. That's exactly what happened. It's not rocket science. You can see that too. So at this point on the weekly charts, we need to come all the way down here for, and I even put that out today, where I said no markets create a tradable bottom till these things on the weekly, given the shape and the trajectory of the downside acceleration, they start to bottom. And even a small move like that can create a 600-point rally. Another move like that can create another 400-point rally. And as it climbs forward, can cause another 400-point rally. Look at these candles. Huge. These are worth hundreds of percentage points on option trades on a weekly basis. Hundreds and hundreds. Small gets really big during that time, but we're not there yet. So it's exciting to me because we're getting there. Let it get there. In the meantime, do some short-term short trades. So at this point, the same level comes into play, 2720, and a round figure of around 2700. You can see that. This is a live bar. We were actually we were getting into this falling wedge, but that's gone. A breakdown of a falling wedge. Remember, this was the galloping horse. Well, it's no longer a galloping horse. This was the bull flag. It's no longer because it broke below that right there. So now it is gonna be like this. Now, if we break 2700, the next levels come into play is around 2750. The 2018 break-even level is 2670. It's possible. Remember, technicals on a short term can change overnight, but longer term technicals on a weekly, monthly, we're going to take a monthly look at the peek at the monthly charts too, do not change overnight. Obviously not, because the time frames are longer. So this is definitively, this till here, it was still technically fine. But this week, including tonight, has done tremendous technical damage that will create massive forced institutional margin sellouts. Remember, institutions, hedge funds, and many high net worth retail net worth clients, tongue tied there, they trade on leverage too. Margin can be a beast on the upside. Margin can be a complete decimator, a widowmaker on the downside. And that is what's happening. Leverage. It's always been the case like that. So now we're broken. So look at this level and look at the lower Bollinger here. See this Bollinger level right there? That lower Bollinger is 2650 roughly, 2645. So 2645 from here is roughly 100 and about 100, and we closed at 2788. 1 second. Just want to be exact. It's roughly 143 points multiplied by 7. That's another roughly 1,000 points. Just preparing all of you, all right? Yes, it's numbers. It's all numbers. So if we get to the lower Bollinger right here, over a period of weeks going into June, we'll have reflex rallies and stuff, and then, they'll hit whack-the-mole job, right? And the market does want to go there. We don't know yet, but it is certainly showing that it hasn't even bottomed yet. It's getting there. We could possibly get there by tomorrow morning with futures down 24. Maybe. I don't think so. I think we need to go to 2,700 before we can see this bottoming process start. But this is basically 1,000 more points on the Dow. Best way to do it is through the indices. You can short individual stocks. Hey, I suggest a few things. I can't cover everything, so use the SPYs. It's the easiest way to do it. Use the DIA. That's another one. The Diamond ETF. You can play short individual stocks, but it's up to you. Cleanest way to do it is through the indices. So this move down here to the lower Bollinger that is still upwardly trending, I repeat, still upwardly trending, is about 1,000 points from here, if not a little bit more. So that's your bigger picture. So like I said earlier on, the market is technically intermediate term broken. Nothing we can do about it. And honestly, President Trump and the Chinese Premier Xi, I don't know what I'm still analyzing in my head the repercussions of this Mexican threat against Mexico, 5% tariffs, and then increasing to 10% in July. I'm scratching my head here, seriously. Given the fact that the USMCA deal, trade deal, was successfully negotiated, and President Trump was going to push it through Congress, because the Dems, as usual, are going to be trying to block it. For what? It's a great deal. And then right there, to attack one of the major partners in the USMCA, which is United States, Mexico, Canada trade agreement, I'm just scratching my head here, just trying to think. So on the eve of this deal getting, pushed through Congress to come out with that, what's the real story behind? We don't know. So that's it. This is 1,000 points here to the lower Bollinger. I have a line drawn here from a while ago, 2,600. If things remain the same, ladies and gentlemen, and hear this carefully, we are going to go to 2,600. That's about 2,100 points in the Dow. We're going to go to 23,000 on the Dow Jones Industrial Average if things remain the same and escalate. And let me show you on a technical pattern, that's going to be another generational buying opportunity. So keep your eyes wide open and listen and look, because I'm going to draw it out for you guys. Actually, I talked about this a while ago. So here's the picture. This is a monster. Monster. Head and shoulder, inverse head and shoulder pattern. These things don't get broken in one day. So now that we have this going on, there'll be a mini bounce here. Possibly it'll attempt to try to go back to 2,800. Then the move down, a little bounce here, and then the move down towards 2,600 will create the ultimate right shoulder, left shoulder, 2,600. We break 2,600, we're done. But forget that for now. Focus on this. Massive. Now, this is a head and shoulder. You all see that. I've talked about this. Head, left shoulder, right shoulder. So that's negative, right? So that head and shoulder neckline is here at 2,700. Does everyone see that? That's your neckline right there of this part of the head and shoulder. Head, left shoulder, right shoulder. These things take weeks to develop, but I'm showing you exactly what's going on. This neckline is critical. You either bounce at the neckline, you can slip aside a little bit, slip and slide a little bit, but if it either bounces and that bounce gets rejected again at the right shoulder, remember, right shoulder, then you get the big drop down towards 2,600. Fast and furious, going to happen within days. So question is, if we go to 2,600, now I'm going to draw a cleaner chart. Look at this. There's your there. Left shoulder, right shoulder, the massive head that was created off the 2,300 bottom on the market, which was a generational buying opportunity. Never miss one of those. Never miss one of those. If we get one of those, can't miss it. Okay? Just buy something, look at my long-term charts, buy some calls 2-3 months out, 2 months out, and just leave it there and watch the money grow. But we don't get those type of opportunities too often. So if we do get one over the following couple of months or the following couple of weeks, let's not just sit there. Remember one thing, the Fed is being extremely accommodative. So that's a big plus. That's a huge plus. The Federal Reserve is not fighting us. They're not saying we're going to raise rates. They're like, we're going to ease rates if needed. We're no rush. The Federal Reserve is the biggest friend to the markets right now. I'm talking about markets here. The biggest risk to the markets are the trade wars, the global supply chain breakdown, the yield inversion, inverted curve on the bond market flashing severe recessionary signals. the sentiment indicators, which contrary are contrary buy indicators, but at the same time, nobody wants to buy the market. So, and the other biggest risk we don't know yet is if earnings warnings coming out of multinational companies and U.S. companies. Look at the IWM. It should be a lot higher. The Russell 2000. These are U.S.-based companies primarily doing business in the United States. So even with the economy moving at 3%, growing at 3.1% as of the GDP numbers this morning, and the whole administration saying the economy is in great shape, which I believe it is overall. Why isn't the Russell 2000 at new highs? They're not dealing with China. Think for a minute. There's something not right in the picture. The Russell 2000 is US-based domestic companies. That's one of the reasons being there's a whole bunch of banks, especially smaller banks, in the Russell 2000, and they are suffering, and they cannot move higher because of the suppressed interest rate suppression with 10-year yields now at around 2.227%. Great for homeowners, but even the home sales are not going higher, because when people get really worried, they're like, screw the fact, excuse my French. Hey, I can do some refi at these levels, but I'm not going to go out there buy a bigger house because rates are I can get a mortgage rate at 3.5% or 4%, 30-year mortgage. They're not going to do that. Think about that for a minute, okay? So that's one of the reasons why the Russell 2000 is suppressed. A lot of banks, but overall, I don't quite get it. They should be immune from these global trade war stuff, but they can't even move higher. Anyway, let's look at the technical part of it. So this is it. If it gets there, 2600, if it gets there, then monster. That's going to be your left shoulder. So as you can see this pattern, and you all know because I've force fed you all on how to read these head and shoulders and inverse head and shoulders. So by now you all know that's it. Maybe we get there. If things remain the same, maybe we get there by the third quarter. But things happen so fast, I can't even say it's going to be months out. It could happen in a couple of weeks. So that's it. So that's the bigger picture. The other chart that I'm going to show you is the monthly. Do I have that up here? No, I don't. So I'll pull it up where you find individuals. ES monthly. This is your monthly chart going back to 2009. It was still an inside candle when I did the last webinar, which was about a week ago. Apologize about the little disruptions in the middle. I should, whichever the case, this is now a bearish engulfing candle, as you all can see. As you all can see. Now let's put a stochastic here to see what is happening. This is external, remember. Let's look at internally what's going on. Lots of indicators you can put, but let's use a simple one. A simple and a very effective one. Ladies and gentlemen, no good. No good. Now, I don't want to scare you all out of the market because we're still going to be making money on a lot of different things, but I'm showing you overall picture of what the market is telling us. Why no good? Because first, bearish engulfing, body of this candle has completely engulfed and gone below the previous bullish candle, which was formed in the month of April. So now you can also draw a head and shoulder here, inverse head and shoulder, look. And where does that lead us? That leads us to 2600. Or thereabouts. 2600, 2650. Right there. Now, let's look at the internals. That's what's going to tell us the health and what kind of infection the market might have. Well, the market's right now got a case of major anxiety, that's causing diarrhea, that's causing all kinds of other ailments, and I'm just letting you all know. So let's draw a inverse head and shoulder on the stochastics. How about that? And that brings us to this level here. Are we there at the 60 level? Nope. We're getting there. This is clearly a crossover down, as I keep on, as my terminology goes, crossover up and crossover down. We love crossover ups and crossover down. We start to get cautious. We trade smaller. We trade faster. We do more shorts. And right now, the monthly is telling us that unless something changes dramatically, and anything can happen, the different worlds we live in nowadays. A simple tweet from President Trump, one comment, conciliatory comment out of China. I have no idea about this Mexican stuff going on. I think this is like he's really pulling a. Is there any term called a Mexican punch? I don't know. Punch bowl. How about that? This is like a Mexican tequila shot gone wrong. Because what the basis for this comment, I'm still trying to figure out here. I'm not talking about illegal immigration. I mean the fact that everything's going smooth. He's pushing this USMCA trade agreement, fantastic agreement that they negotiated between Canada and Mexico after a lot of back and forth, if you remember, months ago. And then right on the eve of that, President Trump, throws this out. So I'm still trying to analyze it. So give me a day or so. So bottom line is, if we get there, then this could happen. We break this, that means the market's going way lower. So this is your monthly chart. I'm going to be showing this. I'll show it at least once or twice daily. Once is good enough, and you can see what's going on. So this is definitely broken. We have a mid-level. We have a channel, lower channel level here at 27.48, and then of course we got all the way down 2400. Forget that part. But if we do break these levels here at the 2600, we are in deep trouble from the standpoint of what the markets can go. The markets can go to 2500. Now these are over months and months, so I can't really tell you. I do not think, humbly speaking, in my humble opinion, that President Trump will risk a complete blowout of the U.S. economy right before critical elections in 2020. It just doesn't make any political sense. Okay, it doesn't make any political sense. And for that, he needs the cooperation of the U.S. financial markets, U.S. businesses, who shouldn't just give up on what's going on. So saying all that, let me try to wrap this up because these are important things that I'm talking about. So look at this here. This is the same chart, but this is what I'm looking at. This is your daily chart. That was your S&P 500 creating a nice little green doji today. Very heartening, which told us that we could have gone up to about to this yellow line here, which is the 5-day moving average at around 2805. A lot of stocks would move up nicely. We would do some selling. We'd evaluate what to do around here, but all that obviously has changed tonight. For now, has changed. So this is not live. So let's look at the live version. Live version is your E-minis. The E-minis, despite what is happening right now, this Mexican standoff, guns drawn, then we are still in a bottoming process. I mentioned this earlier today. Look at this. It can still go lower. The stochastics can still go lower. These lower level readings were registered back during the big December sell-off. Those were around 4, as low as 3.62 right there. We are right now, as of now, still at 11.4. If you can see the numbers here, you can check this on your own screen too. So we can still go lower. And at this point, they should just let it go. Let's flush out big time and create massive buying opportunity. That's the way a tactical trader thinks. Why hold back something? It's like, you're feeling really sick, you're car sick, or you're seasick, and you're just holding it back, holding it back. Just let it go. Just let it go. Don't jump off the ship, but just let it out. You don't have to jump out just because you're gonna throw up. Because you had a couple extra drinks the night before. Just So that's what the market should do. Just let it go. All right.
Man overboard.
What was that?
Man overboard.
Yes, there you go. You're not going to be man overboard just because you're feeling sick, right? So that's what's going on here. So when I say let the market just let it go, I mean these levels here. 27.35, 27.25. Again, the 27.20 comes in, and you can see this line here, 150-day moving average. Each time the markets hit these levels, they try to bounce. They try to bounce because these are long-term support levels. Now, back in, just to remind everybody, back in March, we actually slipped very nicely and created a massive buying opportunity on the 8th of March, all registered, all alerted. Very difficult trading days, 1, 2, 3, 4. Markets were trying to come up, holding the 200-day, starting to, go up and then just throwing up again. And final flush came about on the 8th of March. You can see that. I'm going to zoom in, and that's pretty much the same scenario being played out right there, creating a massive handle, huge 400, 500 point type of reversal right there on the 8th of March. Then on the 9th of March, actually it was the Friday, and then on Monday it opened down a little bit and then took off like a monster. Okay, so will that be done this time round? It also happens to be a Friday coming up tomorrow. Remember, these are all structural pattern symmetries, and they do replicate. They do replicate. Will that happen? Will we get a real flush down tomorrow? And then on Friday, we open down a little bit and then Monday, we open down a little bit, then we take off? Possible. So in order for that to happen, we need to just get it out of our system. And in order for that, get it out of your system, we need to come down and retest. We need to be down 200, 300, 400 points down towards these levels here. And if we go to 27.25, this is where we are right now. We are at 27.70. That's 45 points, 45 handles as we call it, multiplied by 7 or 8. You're talking about 350 to 360, let's call it 400, because by the time the market goes 360, it normally flushes down to 400 and then gets a reversal bounce. That's like just psychological numbers. So if we do go from here where we are right now, this is real-time charts, like to remind everybody, then we will basically come down 400 points. Let's test this level. Just scare the living, I don't even have words for it, like complete, like the whites of the eyeballs, like whatever, the skin of your brains, like make up anything you want, okay? Like complete, like fear, get down towards the 2700 level, you will 90% probability get a short, sharp reflex bounce that might last a day, that might last 2 days, but you got to catch it. But in order for that to happen, like a slingshot, you need to get down towards these levels. So unless the market gets down towards at least 27.46, 27.25, you're simply holding back what's going to inevitably happen, which is a massive throw up, in my opinion. Okay, so just clean out your system. So that's just preparing everybody for it. So be excited at these levels instead of being terrified, because now I already told you what the scary story is. Right, there you go. It's like The Haunting. You're little, like, you're watching the whatever, the Amityville Horror, or what was the other one, The Exorcist, or something's crazy, or the girl's head's like spinning around like crazy. So now that you know it, and imagine us as children, you're not scared anymore. You're like, Mommy, I already know what she's gonna do. She's gonna flip her head around. Okay, so what I did tonight was show you that the flip head around, you should be excited, not scared. These are the levels the market will have a sharp bounce. Does not change the downtrend. Just want to remind everyone, we are still on a technical downtrend. And you might say, why, Frank? Well, as a non-dogmatic technical person who is overall very bullish on America and overall markets, we are right now currently entering a mini bearish phase if things remain the same. So why? So let's take a look at it. Very simple. And I'm just teaching you all this so you all can read it yourself. You have this blue line here, the 20-day moving average, just sharply coming down. Generally, it at least attempts to go kiss the back end of the 20-day moving average and then fails again. This time, it can't even do that. That's why I said the markets are deeply worried. Money's flowing out. What we're doing here is this line here, the sloping, downward sloping. I repeat, downward sloping. We're broken above that. We were breaking above that till the 21st, till the 22nd of May, just a couple of days ago. We attempted to break out over the downward sloping short-term 5-day moving average, 5-day SMA. Simple moving average. I like to keep some things simple. I just look at the 5-day SMA. Some people use the 9, some people use whatever. But we use whatever. I use 5 because there are 5 trading days in a week. So this one is trending down. So I was saying like, okay, look at this number here. I don't know why my screen's shaking, but that's not me doing it. Okay, so that right there was 2,800 roughly, 2,800, 2,795. Said, okay, we can at least bounce towards 2,800 or so where we do another round of selling, but looks like that, well, that doesn't look like the case right now. So at this point, looking at these levels here. So why do I say the market on a short-term basis, intermediate-term basis, is technically broken? Why? 20-day has crossed below the 34-day. I've said it for a long, long time, ladies and gentlemen, and it looks like it's happening. These lines are starting to curve down. These lines are starting to curve down. When these lines start to curve down, it is projecting caution. It is projecting lower prices. Now, at one point, we are good. Once we get around here, we're going to be, well, I'll cover that in a second. So, so right there, see that? Lines are curving down. They're curving down. You can see that clearly right there. I can see that even without my reading glasses, with my computer glasses. It's starting to curve down. They're all curving up. All these time that the market's corrected and we pulled up and stuff, the lines were still trending higher. They're now trending down. The 20 has crossed over the 34, has crossed below the 34-day moving average and the 50-day moving average. The 5-day moving average crossed below the 20, the 34, and the 50. It started to go up a little bit, then see you later. So this is starting to curve down. That's the most important thing here. The 200-day moving average, believe it or not, it's 200 days, obviously. It's just still moving sideways. See, if somebody told you what was going to happen in the market throughout this whole thing and stuff, all you had to do in a very simplistic manner is look at the 200-day moving average, that's this white line, and look at the 150-day moving average and look whether or not they're going flat or they are starting to curve down. When these babies start to curve down, we're in a full-fledged bear market. Because even during this massive downturn, these lines did not curve down. Does both of you see that, Mike and Mike?
Yeah.
Exactly. So that's, you don't need to be some frigging Wall Street like honcho, like, yeah, I know what's going on. I'll give you the story. Hey, I'm giving you the simple story because I'm an ex-Wall Street guy and I'm a royal idiot, okay? Because I look at things in a simple manner. Of course, there's a lot of strategic, complicated stuff that I look at, but let's try to keep it simple on this one. These lines, which, the KISS principle, keep it simple, stupid. So these lines are still moving sideways, which is a good sign. Despite this horrific massacre, what they were calling for complete Armageddon back in December, despite these mini pullbacks that everyone just freaked out, despite this pullback even, which a hardcore bull might say, hey, relax, dude. This is still within the consolidation range. This is still the galloping horse. It still is, believe it or not. It's only when we break this level here that the horse really starts to buckle. Does it become, at that point, does it become a mule? Does it become a fox? Does it become a, I wouldn't say dogs because I love dogs too much. A hyena? Does it turn into some kind of weird creature? I don't know. But at this point, it is still the rising wedge and this. Now, below the 2720 level, 2700 level, it morphs into a different animal. So please stay tuned to Clueless Ape Trading because I will name that animal whatever at that point if that happens. Okay, but aside from there, this is what we're looking for. So these are certainly signs of stress, duress. But at least at 50, at the 150, 200-day moving average is moving sideways. That's a good sign. We are extremely oversold. There's no question about it. And honestly speaking, on a final note, ladies and gentlemen, well, actually, before I give you the final note, let me show you the NIMO. This is your New York Stock Exchange oscillator. It was actually doing pretty nice today. It started to turn around. This, by the way, is not updated real time. This particular chart that I use is only updated around 5:30 or 6 p.m. every night. So I got to wait patiently to see where it lands up. Gives me a nice directional flow. So this is what it was looking like. Don't know what it's going to look like tomorrow. We'll leave it at that. And generally, when they start to bounce up, markets are ready for a nice reflex bounce. That's exactly what it was shaping up. This was looking fine. The MACD was still kind of like had a positive divergence. And this baby, the full stochastics, got overbought, and we're coming down to a level where it would attempt to bounce a little bit. This was still on the negative side. But aside from that, this was looking good. But we shall see what happens. And most importantly, we were at minus 45. We were at minus 63 when the market 69. You could have bought hands down back on the first part of May, and the market's bounced hard, 400 or 500 points, 600 points. That was in March. Market bounced really hard. Anytime you get below the 50-60 range, I've repeated it before, minus 50, minus 60 on this particular chart, ultimate indicator, you can go long on a swing trade. You can. Now, what happens intraday, I can't tell you. It's going to be chop central. You can get tweets like this coming out, but this is generally a very reliable indicator. So this is what it looked like tonight. It closed at minus 45. And the buy zones are minus 50, minus 60, even minus 45 is a buy zone, minus 69. And if you go down to that minus 93 level, you literally buy it hands down. So just another indicator that I use. So the final word that I'm going to say, that despite all the technical mumbo jumbo, all my smart, educated diatribe, right? Another $10 word, and explanations on everything, I could be dead wrong, okay? Because tomorrow, my good old New York boy, Trump, Donald can wake up and say, hey, dude, just playing a joke. No, he's not going to say that. But the markets might very well, on a serious note, I'm going to end. The markets might very well say, F you, I don't give a crap anymore about this tariff crap. I'm just going to focus on what I'm doing because you ain't going to stop trade coming in from Mexico. That's for sure, because that's a lot, guys. That's a lot. Your friends, anybody who lives there, and thing, forget the illegal immigration issue. That's a serious issue. I understand that. But aside from the amount of trade that happens between our two countries, all the beef, the poultry, you name it, huge. And then the gasoline products and the assembly plants out there, car manufacturing plants, you name it. We depend on it too hard. You cannot cut that supply chain by putting 5-10% tariffs on the eve of a major bill that Mexico is the biggest component of it, that President Trump himself negotiated successfully, very successfully, and that to just fall apart. It just doesn't make sense. So saying all that, futures are down about 18 points right now. We were down about minus 27. We've recovered about 10 points or so. This is your infamous 200-day moving average that the market is always trying to hold and stuff. I just say let it go, okay? But the point is, the markets might just say, F you, I don't care. We just want to go. We just want to stick to what we do best, which is make some of the finest products in the world, work out the trade deal, and move on. So this could be a distant memory. But what I did show very importantly, all of you, just be aware of the charts. Start learning the charts. Even if you're not trading on a certain, you don't have to trade every day. You don't, seriously. Okay? So at least go through my Twitter feed. The few dollars that you pay every month is worth thousands and thousands of dollars in your pocket, because this is the ultimate learning experience. And I'm providing you with the ultimate tools, explaining through these webinars, through the real-time Twitter feed, how to read the market, how to manage your own money, whether it be trading money or investing money. So use this time period as a massive real-time classroom using all the resources that we provide here at Clueless 8 Training. On that note, God bless you all. See you guys tomorrow. It is going to be another one heck of an interesting day. But now that I've shown you all the goblins and all the ghosts, you do not need to be man overboard. You just need to let it go, stand there, make money. You know what the risks are. The rewards are plentiful. But now we are aware of the risks, immediate risks that are in front of us, both long-term and short-term. You don't need to be scared anymore. So on that note, God bless you all. See you guys tomorrow.
Bye-bye.
Thank you.